Hello and welcome to this week's edition of the Retirement Compass, the show designed to help you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio is Tim Kulhanek. He is the co-founder and a financial advisor at Stonebridge Wealth Systems. Tim, my friend, it's great to be back in the studio with you.
It's a pleasure to be here. Thank you for having me.
Absolutely. Well, I love that this show has taken off. I know that you guys have been so busy helping and serving folks who've been calling and coming in. Talk a little bit about what has been transpiring, because I know you're now looking to expand as well.
Yeah, we are. So not only expanding offices, so it's a pretty exciting time at the firm. So we've moved into the Omaha market. We've got a really nice office there, not far off of Dodge in the Miracle Hills area. We brought on a few advisors to help with that office. We've got a new office location that we're moving to in the Lincoln market. So we're basically tripling our size in the Lincoln market. And so really excited about what that's going to look like. It's kind of under development right now, but here towards the end of 2024, we'll be moving into that new space. But the other thing we're looking at doing is, we've had a great response from the audience out there with not only our radio program, but also the television program. I think that our message resonates. I think they're hearing, they're like, you know what, I need more than just some whiz-bang type of financial product. I need a plan.
Yes.
I need a strategy for how I'm going to get to and through retirement. This inflation's killing me. I'm worried about the market volatility. I know that the market goes up and down, but man, how do I make sure I hang on to my dollars when things don't go so well? And what do I do to make sure that I'm gonna have the income that I need to live on and be able to do the things I wanna do and not worry about this junk, because this isn't what I wanna do. I don't wanna sit in front of a computer all day. So that type of message where we're talking about planning versus products, the response has been great. So we're looking at even moving into additional markets with the TV program throughout the region, even beyond the state of Nebraska. So we're really excited.
That's so exciting. I'm so happy for you guys. And I mean, it's been such a joy getting to know you over the past year and doing the show with you all, and just to see the response. And really, I think you hit the nail on the head. So many people get it confused. They think, oh, I've got these investments, I've got my 401k, I've got my IRA, I have my statements. That's my plan. That's not what a comprehensive holistic financial plan is. Those are tools and part of the plan, but they are not the plan in of themselves.
Exactly. I would say one of the biggest questions that I get when folks come in, they say, well, how do I do it? Like, I've got all this stuff, but how do I make it go? It's almost like building a car. I've got this engine, but where do I sit? Where are the gears? Where are the tires, the wheels? Where do I put my kids or the family to take on vacation? I've got to have the whole thing. The investments are important, but it's only one piece of the overall, makeup of what the actual plan is going to be.
Right, for sure. And I think now there's even more of an understanding that, we say this on the show almost every week, at least once, if not more, that how you make a decision in one area of your financial life does and will affect all the others. That's why you have to engage in this from that comprehensive, holistic perspective. And I know today's subject that we're going to be spending the bulk of our time talking about is underestimating healthcare costs. And I think one of the main reasons, we know that the number one fear of most retirees is running out of money and not having enough money to last them throughout the rest of their lives. It's the healthcare piece, I think, that is contributing to that, which we need to talk about, because we know those costs are going up, and it's really hard when you don't know if you're going to need that kind of care, how much care you're going to need, how long you're going to live. So we've got a lot to talk about today.
We absolutely do, because the reality is, for most of the viewers out there, healthcare costs will be the single largest expense that you have to deal with in your retirement. And the question is, are you prepared? What's your strategy? It doesn't mean you have to go out and buy necessarily some insurance product to pay for it, but you have to have a plan of where are those dollars going to come from. How do I make sure that, for folks that are married, that my spouse, if something were to happen to me and I couldn't get out of bed tomorrow, not because I've passed away, but because I've become incapacitated in some way, how am I going to make sure that she's taken care of? And I know, guys, that is a major concern for a lot of you. So that's something we're going to talk about today.
Yeah, for sure. Well, gosh, there's so many different directions we could go. I know we want to start off by talking a little bit about Medicare premiums, because there is a huge misconception out there that folks think that Medicare is going to cover everything, but Medicare doesn't cover everything. So let's start with that.
Yeah, so let's just break down Medicare into its different parts. So Medicare, it's actually a pretty complex program because it's a government program, so it has to be overly complex, overly engineered. But if we just want to simplify it, there's Medicare Parts A, B, C, and D for the most part. A, that's what covers hospital insurance. So if you go into the hospital, maybe there's an accident, you have some sort of heart issue, whatever it might be, that's like inpatient type of care, not outpatient, inpatient, that's going to be covered under Medicare Part A. Now to qualify, in other words, be eligible in general, this doesn't apply to everyone, this is general, not universal, you have to have what we call 40 credits, which to earn 1 credit, is kind of, there's a little bit of overlap here between Social Security qualifications and Medicare. You have to earn roughly $1,700 in 2024 to be eligible for 1 credit. So it's about 10 years of part-time work. So most people are going to qualify for Medicare Part A, and it'll be what we call premium free. It doesn't mean that it is a free benefit because you paid in, but you won't have an ongoing premium. However, for physician services, durable medical equipment, that sort of thing, outpatient services, that's going to be covered under Medicare Part B, all right? So you got A and B, that's what we call original Medicare. B does have a premium. In 2024, I think it's it's almost $175. It's like $174.70.
That's the base amount.
Yep, that's the base amount. We can get into the nuances because again, it's way more complicated than it should be. But in general, that's A and B. So if you think of folks, your red, white, and blue Medicare card, it used to be, it's kind of funny. So when I first started in this field, I don't know if it was 14, 15 years ago, Medicare was kind of my focus. And that red, white, and blue Medicare card that you have, it would have your Part A effective date and Part B effective date, which aren't necessarily the same. It has to do with your continuing working. But your Medicare number used to be your Social Security number and a dash and like an A or a B behind it. And then we figured out that, having your Social Security number on this card you carry around everywhere with you and people are losing their wallets and their purses and such probably isn't a great idea.
Right.
So that's since changed, but that is actually what if you went to the doctor, you'd show them your Medicare card, Part A, Part B. And then you get into like Part C, which is an Advantage plan, which is a whole nother program. It actually pays in place of original Medicare. Part D is like prescription drug plans. So, you know, I would say in my experience, and I don't know if with any family members you've had this, Kristen, but probably the most expensive aspect for a lot of folks when it comes to Medicare is actually their prescriptions. So you've got these prescriptions that are several $1,000s per month.
Right.
And they get into what they call the donut hole or the coverage gap, depending on what nomenclature you want to use. And all of a sudden they're paying, you know, a huge percentage of that cost. I can't remember for sure if it's about 50%, but it's a large percentage where it's just out of pocket. And that's really, really tough on folks. Now there's some legislation that's been passed that's trying to close that gap, but it's a serious concern, again, why you have to have a plan, plan ahead, and a holistic plan, not just investments or gadgets, in order to be truly prepared for retirement.
No, for sure. We often call it the Medicare alphabet soup of Medicare, right? Because you've got all these different alphabet letters, and then if you get into Medigap policy, oh my gosh, it can just get so overwhelming and so confusing really, really quickly. But one of the things, you mentioned the average cost of Medicare premiums today. However, we need to talk about something known as IRMA. So define what IRMA is and why our viewers need to pay attention to it.
Well, some folks probably know someone named Irma, but I'm aware of some IRMAs out there, but this is a different IRMA. So this is an acronym or initialism, whatever you want to call it. There's an argument over the proper terminology there, but it's Income-Related Monthly Adjustment Amount, IRMAA. And all that means is once you have earnings, and they use a figure known as modified adjusted gross income. I won't get into the details. Just know it's for most people, it's going to be your adjusted gross income. I think it's line 11 on your 1040. Once that gets over a certain threshold, so for example, married filing jointly, that's going to be up $206,000. You have to pay more for your Medicare, and there's several different thresholds you can go over to where you'll pay 2, 3, or more times the base price. And so why this is important is that's based off of what we call a 2-year look-back period. So in 2024...
2 years of looking back.
Yep, exactly. They'll look at 2022's modified adjusted gross income. So what that means is if you're planning for doing some things at age 65, and you're planning on retiring, you're going to go on Medicare, you have to keep in mind that there's a chance that you're going to have to pay more. So if you're doing things like Roth IRA conversions, or what people ask me all the time, Tim, when I retire, I'm going to, I want to cash out my 401k, I'm going to pay off the house. In theory, it sounds great. But then you get into the details and you realize, wait a minute, no, you locked in an interest rate back in 2021. You're paying 3% fixed.
Right.
And you're going to cash out your 401k, maybe $250,000 with your 401k, push yourself into a higher tax bracket. You're going to pay 24%, plus now you're going to have to pay substantially more for your Medicare, which they forget about. So
or a lot of people just aren't even aware of that.
Yeah, that's the main reason is they're not aware of it. So really what it comes down to is you don't know what you don't know. And, you know, every year there's these studies that come out and they look at what's the value of a financial advisor or financial planner. And, you know, a lot of us think in our minds, oh, it's because maybe they'll get a better return. And a lot of advisors I think you've gone into and met with in the past, if you've ever done that, they might say, hey, you know, look, you know, Mr. and Mrs. Smith, you did great last year. You know, you made 7%, but if you'd been with our firm, you know, we probably could have got you 8 or 9%. And then on these other investments over here, you know, maybe you got some money in some stocks or some mutual funds over here. They did pretty good as well, but you know, we probably could have beat that if you would have been with our firm. So just go ahead and move over here and we'll take care of that. Now, as far as your insurance and your Medicare and your Social Security goes, you know, you could reach out to Social Security maybe and get some help with that. I'm here to tell you that's not how it works. Social Security is not going to help you. They're actually not allowed by law to give you advice, and they can't give advice on Medicare either. That's why working with someone like Stonebridge and a holistic planner where you're going to get a comprehensive plan, a written financial plan, that's what we think everyone needs, and I think we all would agree after this brief conversation, there's a lot more to it, and that's what we need to be focused on.
Absolutely. Tim, thank you. There's a lot more to it. We're going to get into some more of that after this break, but this is a great opportunity for you to pick up the phone and call to claim your complimentary written financial plan from the team of Stonebridge Wealth Systems. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how Tim and the team can help and serve you. That number to call is there on the bottom of your screen, 866-256-7778. Or if you'd rather connect online, simply pull out your smartphone, and if you open up that camera app, you can point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Stonebridge Wealth Systems will reach out to connect with you to schedule your complimentary meeting that way as well. We've got a lot more to talk about. Stay with us. We'll be back right after this.
Our team is very unique, so we all have different gifts. You know, when you put it all together, it fits well.
Jeremy is definitely our most seasoned and fastest growing advisor we have. He's discerning, so he understands the way we want to do things at Stonebridge, to focus on the client and solving their problems, and that's really what he's passionate about.
I know Tim spends a lot of time making sure that all the I's are dotted and T's are crossed for his clients. And he's not just satisfied knowing the 30,000-foot view, he wants to get down in the weeds and know exactly how it works.
The things that you buy, the stocks, the bonds, the mutual funds, that really isn't that important to the client. What's important to the client is, what does this mean for me? And at the end of the day, what it means is they can sit back and listen to the music. You know that you've got a team, not just one person, but an entire team behind you that's taking care of those things, so you can focus on what's important.
Do you own an annuity? Are you aware of what type of annuity you own? For years, annuities have been a cornerstone of retirement planning, but they're not all created equal, and your current annuity might not be serving your retirement goals. The good news is, rising interest rates could mean better guarantees and better benefits for your annuity. If your annuity is not working for you, wouldn't you like to know sooner than later? Call now for your complimentary annuity review.
Welcome back to the Retirement Compass. I'm your host, Kristen Oakley, here with Tim Kulhanek. He is the co-founder and a financial advisor at Stonebridge Wealth Systems. And we're having a great conversation today all about underestimating healthcare costs as you get older. Before we dive back in, Tim, sorry, I know Jeremy's usually here with us too, right? You're sitting in the seat. It's all good. But I'm curious, you know, for folks just to help remember why this is so important, what is the average estimated amount of money someone will have to spend on healthcare potentially in retirement? What do the statistics currently say?
Yeah, so I looked at some information on that, and the reality is it's kind of all over the place, but according to a study from Genworth, it estimates that by 2031, a private room for a nursing home could cost around $145,700 per year, while a home health aid would cost about $83,000 per year. And a 2020 survey of consumer finances revealed the average retirement savings for all families is only $333,940. So if just one family member needed some sort of, let's say, extended care or long-term care, that's wiping out a good portion of everything you saved.
Yeah.
So, there's different numbers out there, but the reality is it's a lot, and that's why I said earlier, it's the single largest expense for most folks.
Yep.
Here's what we do. I can tell you how we do. So for folks, if you're wondering, well, how can Tim and the team of their elite advisors help me if I go in to visit with them? When you come in, we can put together a comprehensive plan. But what we do is we estimate based off the average cost is today for long-term care, and then we build that into your plan using an accurate inflation rate based off the last 20 to 30 years. Inflation for healthcare costs have been 2 to 3% higher than the average inflation rate. If the average inflation rate has been, let's say, 3.8% for the last 50 years, we're going to run that at 5.8%. And so what we found, Kristen, is that folks, like, these are mind-blowing numbers. When you actually do the math on it, and let's say that they're 62 years old, and we're planning for maybe a 30-year retirement, and we're assuming the last 2 years of their retirement, they're going to need some sort of assistance.
Right.
We're seeing people having to potentially pay, in excess of $200,000 per year per spouse for long-term care. Devastating numbers if there's not a plan in place.
Exactly. I mean, it can absolutely wipe out someone's retirement savings, and very quickly. And I'm thinking of the other study that came out a few years ago that said that for a couple who reaches the age of 65, they can guarantee that they probably will spend at least $300,000 on healthcare costs. And Medicare doesn't cover things like long-term care. I mean, this is the issue, right?
Yeah. Well, that's just it. And sometimes we get into, okay, does this number actually include a long-term care event? And some of the statistics I've seen, it's a few $100,000, and it doesn't include long-term care.
Right.
It's literally just
covering healthcare basics.
What we were talking about earlier in the first segment. It could be prescription drugs, going to the doctor, getting your annual physical, which a lot of that's going to be covered under Medicare, but you still have premiums for Medicare that you have to account for.
Yes.
And I think the thing that people need to understand is there are gaps in Medicare.
Yep.
So if we can just spend a moment talking about that. If you think about like Part A, we were talking about it earlier, there's a deductible for that, okay? And what's a little bit of a misnomer is they think, oh, well, deductible, I'm on major medical right now, and my deductible, once I meet that, I'm in the clear, right? That's not how Medicare Part A's deductible works. It's per benefit period. So in other words, if you go into the hospital, you got to pay the first, it's like $1,600 and some change, $1,632 per benefit period. And that covers like the first 60 days, and then from day 60 to day...
$1,632, just to be clear, right?
Yes.
Just to make sure.
$16.32.
Just to make sure everyone's
maybe
hearing that.
70, right?
Yes.
So for days 61 through 90, there's a copay of $408 per day, and then 90 plus, you've got like I think it's 60 lifetime reserve days. It's $816 per day that you're not now. God forbid anybody's in the hospital for 150 days.
Right.
But it does happen.
Yeah.
And once you get beyond that, you're on your own unless you have something like a Medicare supplement plan, which is a whole nother discussion. We could have a whole show on Medicare supplements.
Right.
But the point I'm trying to drive at is there are substantial costs that you have to account for that could potentially be out of pocket. I actually had someone in my office just last week. And so I'll just kind of lay that out for our audience. She came in and she'd been working for the last 27 years at Bryan Health. It's a major, obviously employer here and hospital system. When she retired, she decided she was going to, and she was beyond age 65. She'd been delaying Medicare Part B because she didn't need it because she had health insurance through her employer.
Right, okay.
And so when she retired from that role, let's say she's roughly 70 years old. I think she's actually 68, but around 70, she said, you know what, I'm going to need some health insurance. She wanted to go back to work somewhere else. But she decided, I'm going to go on Medicare now. So she applied for Part B.
Okay.
But she didn't pick up a supplement. And when she was in my office just a few weeks ago, I said, well, when did you apply for Part B? She's like, maybe 3-4 months ago. I said, you need to get that supplement now because there's a window of opportunity for you to get that supplement called the guaranteed issue window, where you can't be declined or turned down because of any health-related issues you might have. And once you go beyond that, there's a risk that you might not be able to get it, and then you really would be on your own. Again, this is why having a plan for all 5 key areas of planning, income, investment, tax, healthcare, and legacy/estate is so critical.
Right, and they all have to fit together and work together because we talked about IRMA in the last segment, right? And you can inadvertently make a decision in one area of your financial life. Next thing you know, your Medicare premiums are going up. It has tax implications and consequences. I mean, so much goes into this.
Yep, absolutely.
Yep, for sure. Well, moving on here with Medicare and its complexities, we talked a little bit about the fact it does not cover long-term care costs.
Right,
And that's a
right.
common misconception. People
Yep.
think, oh, well, Medicare, I've got Medicare, it's going to cover that. So how do you help folks effectively plan
Yeah.
for long-term care? Because I think one of the frustrating things is you don't know if you're going to need it or not, right?
Yeah. So here's the rub with long-term care. Usually what people would do historically is they'd say, oh, I've got a plan for this because I don't want to be a burden to my family, which is true. I remember my dad, when he was probably 60 years old, Jim, is 78, he'll be 79 in February, but he was probably 60, 64, and I remember him telling me, Timmy, he calls me Timmy.
I love that.
Timmy, I don't want to be a burden to your mom and you boys. Okay, I've got two brothers. And I could see in his eyes how important that was, how sincere that was, and how much of a fear it was.
Yeah.
And they explored long-term care, insurance, and different strategies there. But to be really frank with you, Kristen, long-term care insurance isn't for everyone. Because the reality is there's no sense in paying for something if it was going to cause you to not be able to actually enjoy some retirement. And my folks, I thank God that they're my mom and dad, because they did everything to make sure that my brothers and I could have a life they didn't. There was never a time where I'd look in the stands at a baseball game and mom or dad wouldn't be there. Not once. They made so many sacrifices. But one of the consequences of that sacrifice is they didn't have a big retirement fund somewhere. Mom was a teacher. And so, thankfully, the state of Nebraska has pretty good teacher retirement. And so they got Social Security, her teacher retirement, and they're able to do some things. But for a lot of folks like them, paying for long-term care, traditional long-term care insurance, which can be very expensive, it may not be affordable if they're going to be able to do. You don't want to sacrifice your lifestyle completely.
And if you don't use it, you lose it, and then the money can't be passed on that you've paid in, right? I mean, that's the other challenge with it.
Exactly. So here's, for this segment, what I'd leave our audience with. What you don't want to have happen when it comes to long-term care, if you were to ever need it, is you've been paying for some policy and you pay for it for 30 years, and 30 years from now, you die peacefully in your sleep, having never needed any sort of assistance. And so you've lived for 30 plus years while you were paying for something that you hoped you never needed. I don't want that for any of you. And I thankfully am aware, and because of the way we've structured our practice, and we're looking for these more innovative ways to protect folks and provide for their families, we know there's more strategies out there. We've done entire shows on them. Go look them up. You can go to our website, stonebridgeiwm.com, and look at all of our past shows. But I want you to take this and take it to heart that there are strategies out there using alternative means of providing for long-term care. It could be a life insurance policy. It could be annuity. There's a lot of different ones that can more efficiently cover that need without having to have that burden of, man, I'm paying for this and I hope I never need it. So please give us a call at the number below. We'll give you that written financial plan for coming in. Again, it's going to be a comprehensive plan, not just some whiz-bang product. And we're looking forward to seeing you soon.
Wonderful. Tim, thank you so much. Very well said. To our viewers at home, that number to call to claim your complimentary written financial plan is 866-256-7778. Or again, you're welcome to scan that QR code. That will get you connected as well. We'll be back with more on today's episode of the Retirement Compass right after this.
If you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time,
I really should have done this years ago. But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with Tim Colhonick, where today we've been discussing one of the biggest challenges folks need to navigate in order to be able to enjoy their retirement successfully. It's healthcare costs, and we talked a lot in the first couple segments about just the underestimating of healthcare costs that goes on. Obviously, you know, we have to plan for these things, especially with long-term care. We're living longer than we ever have before. I know we only have a few minutes left, but I would love for you to share some of the strategies that you're able to employ for your clients to help them navigate these costs successfully.
Yeah, so there's two main strategies we like to use for covering that long-term care piece that's going to allow us to cover that in a tax-efficient manner without having that, you know, cloud over our heads of, man, it hurts in my stomach to write this check every year for this premium. Because the reality is a lot of those premiums, you know, they're not guaranteed to not go up. And they go up and they go up and they go up. I've seen people get increases of 30% per year for 3-4 years in a row. And then all of a sudden, maybe a couple years go by, bang, it's 60% increase. And I'm not making those numbers up. I can show you the data on it.
Oh, and I've heard you get the letter and it says you can keep paying what you're paying, but your benefit's going to go down. Or if you want to keep this covered, guess what? You're going to be paying this much now. I mean, that's the way it works. Yeah.
Exactly. So two main strategies, just real quick. One would be a life insurance-based approach where in general, okay, I've got a death benefit and I've got a premium. It could be a single premium. It could be you pay for 10 years. You could pay for, you know, what we call life pay. But guess what? It's a level premium. It'll never go up. And if you never need long-term care and you die 30 years from now peacefully in your sleep, having never needed any sort of assistance, that death benefit goes to your beneficiaries tax-free.
Tax-free.
What's better than tax-free?
Nothing.
Right?
Right.
So that's number one.
Yep.
Number two, if life insurance isn't an option because you have to qualify for it because it's insurance, we look at annuities. Couple comes in. They bought this annuity back in 2004. They put $200,000 of their own after-tax money in. It grew tax deferred. They were going to use it for retirement income. Things have changed. They got everything paid off. They don't need that money. It's sitting there. If they were to pass away, that money goes to their beneficiaries. It avoids probate because their beneficiary designation, but it's taxable as income on the gain over their basis. If they need long-term care, let's say it's worth $500,000 today, they have $500,000. They pay the tax bill on the gain. Whatever's left, they could use for long-term care. We switched that into a long-term care annuity that under the 2006 Pension Protection Act qualifies as a tax-qualified long-term care strategy. If they were to need long-term care, the premium could potentially triple. So if they had $500,000, they'd have $1.5 million for long-term care between the two of them, and it comes out tax-free if used for healthcare costs.
That's amazing. Wow.
That's cool. Yeah.
I wish we had more time to dive into these strategies, but really it's going to be a case-by-case basis on what's right for each individual.
And that's why they need to give us a call, because the reality is we can customize this for you.
Absolutely. Tim, thank you so much.
Pleasure.
And thank you for joining us. We know you have questions. We probably brought up some things today. If you want to dive in deeply into your situation and get your complimentary written financial plan, there's never been a better time. That number to call is 866-256-7778. Thanks so much for joining us. We look forward to being back with you next time here on the Retirement Compass.